Insurance was born the moment human beings accepted that uncertainty was permanent. Long before markets, currencies, or contracts, people understood that misfortune did not strike evenly. A storm could destroy one family's crops and spare another's. A ship could sink, carrying a single merchant's fortune, while others arrived safely. Fate was random, but survival depended on finding order within that randomness. Insurance emerged not as a financial invention, but as a social pact, an agreement that no one should face catastrophe alone. The earliest forms of insurance were collective and informal. In ancient Mesopotamia, long-distance trade exposed merchants to dangers far beyond their control. Theft, storms, and war could erase years of labor in a single journey. To make commerce possible, merchants pooled risk. If one caravan failed, others contributed to cover the loss. The Code of Hammurabi formalized this logic by embedding risk-sharing into loan contracts. If goods were lost at sea, repayment could be forgiven in exchange for higher interest. Loss was acknowledged, priced, and absorbed collectively. This was not charity. It was survival mathematics. Similar practices appeared independently across civilizations. In ancient China, merchants spread goods across multiple vessels to avoid total loss. In Greece and Rome, burial societies collected regular contributions to ensure dignified funerals for members. These early systems were not profit-driven. They were mutual defenses against ruin. Risk was socialized because society itself was fragile. The transformation of insurance began with trade expansion in the medieval world. As commerce moved beyond local familiarity, personal trust was no longer sufficient. Merchants required contracts enforceable across distance and time. Italian trading cities such as Genoa, Florence, and Venice pioneered marine insurance contracts that resemble modern forms. Premiums were paid up front. Losses were compensated after verification. Risk was transferred explicitly rather than absorbed implicitly. Insurance became a commodity. This innovation altered the trajectory of capitalism. By separating risk from ownership, insurance freed capital. Merchants could invest without risking total annihilation. Ventures multiplied. Trade routes expanded. Insurance did not eliminate danger. It converted danger into cost. That conversion was revolutionary. London later became the gravitational center of this evolution. In the late 17th century, Lloyd's Coffee House served as an informal exchange, where shipowners, merchants, and underwriters shared information about voyages. Reputation mattered. Knowledge of weather, piracy, and politics determined pricing. Over time, this gathering evolved into Lloyd's of London, a marketplace where risk itself was bought and sold. Insurance had become institutional. The rise of insurance coincided with a deeper intellectual shift, the mathematization of uncertainty. The development of probability theory in the 17th and 18th centuries transformed fate into frequency. Death rates, fire losses, and shipwrecks could be studied statistically. Actuaries replaced superstition with tables. Insurance pricing became predictive rather than reactive. This shift carried profound philosophical implications. Insurance implied that randomness obeyed patterns, that chaos could be managed when aggregated. Misfortune was no longer divine punishment or moral failure. It was distribution. This reframing reshaped how societies understood responsibility and planning. The future became something to prepare for rather than fear blindly. As insurance matured, it extended beyond commerce into daily life. Fire insurance reshaped cities, encouraging safer construction. Life insurance allowed families to survive the death of wage earners. Accident insurance softened the brutality of industrial labor. Insurance became an invisible stabilizer of modern life. Governments quickly recognized its power. Insurance reduced the social cost of disaster and limited unrest. States regulated insurers, enforced contracts, and eventually became insurers themselves. Social insurance, covering unemployment, illness, disability, and old age, emerged as an extension of the same logic: risks, too large for individuals, must be shared collectively. The welfare state was in many ways insurance scaled to the nation, yet insurance introduced new tensions. When losses are covered, behavior changes. This phenomenon, later called moral hazard, was visible early. Insured ships took greater risks. Insured factories neglected safety. Insurance had to evolve safeguards, deductibles, exclusions, underwriting standards. Risk sharing required discipline as well as solidarity. By the industrial age, insurance had become inseparable from capitalism. Factories depended on it. Investors demanded it. Infrastructure required it. Insurance enabled scale. Without it, modern economies could not function. But with scale came concentration. Those who controlled capital and data controlled protection. Insurability became a gatekeeper. What could not be insured struggled to exist. Crises revealed insurance's limits. Great fires bankrupted insurers. Wars invalidated actuarial assumptions. Pandemics strained mortality tables. Each shock forced recalibration. Insurance survived not by denying uncertainty, but by adapting to it repeatedly. In the 20th century, insurance entered everyday life so completely that it became invisible. Health insurance linked survival to employment. Auto insurance became mandatory. Liability insurance reshaped legal systems. People stopped noticing insurance until it failed. When coverage vanished or premiums spiked, risk reappeared suddenly and violently. At its core, insurance embodies a paradox. It promises security while acknowledging uncertainty. It spreads loss without preventing it. It converts catastrophe into cost, but only up to a point. Insurance cannot eliminate risk. It can only decide who bears it and when. Seen across history, insurance is not merely a financial product. It is a moral technology. It reflects how societies choose to distribute suffering, how much uncertainty they tolerate individually versus collectively. It enables progress by making failure survivable. The birth of insurance marked the moment humanity stopped pretending the future could be controlled and instead learned to negotiate with it. By pricing uncertainty, societies expanded ambition. By sharing risk, they made complexity livable. Yet embedded within this success lies an unresolved question. What happens when risks become too large, too correlated, or too political to insure away a question that grows sharper as disasters affect entire systems, rather than isolated individuals, as climate finance and technology produce shocks that overwhelm traditional pooling mechanisms, and as insurance itself becomes a signal not just of protection, but of warning. A warning that some dangers can no longer be transferred quietly and must instead be confronted directly. A realization that would push insurance into its next phase, where the unknown is no longer rare or random, but systemic, interconnected, and relentless, a phase that would force societies to confront the limits of risk sharing and ask whether insurance can continue to protect against the unknown, or whether the unknown has grown too large to be absorbed without fundamental change. A confrontation that would define the limits of what insurance can realistically promise in a world where risk is no longer isolated, but shared by entire systems. For the modern era has forced insurance to confront a transformation as profound as its birth, the shift from individual uncertainty to collective vulnerability. In the late 20th and early 21st centuries, insurance encountered risks it was never designed to absorb. Financial crises no longer bankrupted a single firm, but threatened entire markets simultaneously. Pandemics struck millions at once, invalidating assumptions of independent mortality. Climate change correlated disasters across regions, turning rare events into recurring patterns. Cyber risks cascaded globally in seconds. These were not actuarial anomalies. They were structural shocks. Insurance responded by evolving upward and outward. Reinsurance emerged as a second layer, allowing insurers to pool catastrophic risk globally. Capital markets joined the process through catastrophe bonds and insurance-linked securities, transferring disaster risk to investors willing to bear it for yield. Governments stepped in as insurers of last resort, backstopping flood, terrorism, crop failure, and bank deposits. Once again, the state absorbed risks private markets could not price alone. But this expansion exposed insurance's central paradox. The broader the coverage, the more behavior adapts. When rebuilding is guaranteed, development spreads into floodplains. When losses are socialized, prevention weakens. Insurance can price risk, but it cannot enforce foresight. As premiums rise or coverage retreats, insurance becomes not just protection, but a warning signal, one that societies often ignore until it disappears. The political consequences are unavoidable. Who should pay higher premiums for climate exposure? Homeowners, insurers, or taxpayers? Should insurance reflect pure risk or social equity? When markets withdraw, should governments compel coverage or accept retreat? These questions are no longer technical. They are moral choices about how societies distribute loss. History suggests a clear boundary. Insurance works best when risks are random, independent, and bounded. When risks become systemic, insurance alone is insufficient. It must be paired with prevention regulation and collective investment. Levies matter more than payouts. Public health matters more than claims. Resilience must precede compensation. This does not diminish insurance's achievement. It clarifies it. Insurance was never meant to eliminate uncertainty, only to make it survivable. Its greatest contribution has been to extend time to rebuild time, to adapt, time to plan. When time is misused, costs compound. The final lesson of insurance's long history is therefore one of humility. Risk can be shared, but not erased. Protection can be bought, but not guaranteed. The unknown can be priced, but not conquered. Societies that mistake insurance for immunity discover its limits the hard way. If this journey through the birth and evolution of insurance changed how you think about safety risk or financial protection, share what stayed with you. And if you want to continue exploring how humanity has learned to live with uncertainty through money markets and institutions, follow the channel and stay with this story. Because the history of finance is ultimately the history of how societies confront the unknown and whether they choose to deny it, price it, or prepare for it.